Hey, welcome to the Guarantee Retirement Guy Show. Today we're going to be talking about the common mistakes that people make when purchasing annuities. So I sell annuities. I love annuities. I love them for their contractual guarantees, but there are people that make mistakes, and I deal with it all the time. And a lot of times I'm cleaning up the mess from another advisor. So if you're looking to purchase an annuity the right way, then I would recommend booking a call with me. There is a link below this video, and there's also a link on my website, johnstevenson.com. And before booking a call, you can actually go to my website and check out which annuities are available. So that's one of the big mistakes, and I'll talk to you about that one, is failing to research. Okay. In fact, I'm already on that topic, so I might as well talk about it. Most people who contact me, they are looking at one, maybe two options that are given to them by an advisor that they're talking to, or maybe a friend that they know. A lot of times that friend only has access to one or two companies, or that advisor might only be allowed to sell one or two companies because that's what their broker tells them to sell. Or sometimes they just don't want to show you the other options because their commissions are about half of what they could be getting if they sold you a subpar annuity. And of course, you don't know any better, and you purchase that annuity trusting them, hoping that they're going to give you, of course, the right advice. And of course, they can give you good advice, but not the best. They can say, well, I'm selling you a great annuity. It's a great company, and that may be true, but you may make a completely different decision had you known everything else that was out there. So that's why I always tell people, go to my website and research before contacting me, because that way you can kind of know what's out there, and then you already kind of know if you want to buy one or not. If you do want to buy an annuity, then reach out to me. If you don't, or you're not sure, then just email me and I'll answer your questions. So I'd love to be able to help you. Of course, that's how I make my money. But at the same time, I don't pressure people. Okay. I'm a financial fiduciary and I show you everything that's available. So no matter, I don't care what it pays me. I'm going to show you everything, and then you can make the decision based off of what's best for you. Okay. So research, and I know this goes without saying, but research, make sure you are looking around. And a lot of times people don't know where to look. They don't know that there are annuity calculators out there, and there's not very many. There's not very many because it costs a lot of money to actually put one out, and it costs money every time people submit and look for an annuity on my website, on my calculator. It costs me money every single time you do it. But it is there for you as a consumer to use. And if you're at a professional, please don't use them, all right? Because they are costly. But it is there for the consumer and for you guys. If you're looking to purchase an annuity, I'd love to help you. So anyways, there's my plug for that, all right? The next common mistake, I would say not understanding surrender charges. Okay. I don't know how that happens, but somehow people will buy an annuity and they don't understand that there are surrender charges there. And yeah, there's surrender charges. It's a long-term contract. Okay? If you put the money in, you're getting a lot for it, whether it be lifetime income or a high rate of growth. I mean, let me show you my screen. I'll show you what it looks like. Okay. So if I'm looking at surrender charges, and I just threw someone in here, they got $400,000, they're from Georgia, they're 79 years old, and they want to take immediate income. Okay. And for this instance, a SPIDA, and there's better options out there. I mean, if you're younger, and there's better options. So we'll go in here and we'll say, all right, just for illustration purposes, I want you to see what the actual surrender charges would be. Okay. So surrender charges, here they are for 10 years. This is pretty standard. You'll see that, like, let's say you put $400,000 in, and after 5 or 6 years, you want to take it out. Well, they're going to charge you this to take it out. Okay. They're not only going to charge you that, they're going to charge you a market value adjustment, or they might credit it to you. So it depends. It depends on the interest rate environment. If you buy the annuity when interest rates are high and then interest rates go down when you decide to surrender it, you're actually going to have a credit. It's actually going to give you more money back with that MVA, which is nice. I mean, you'll still have the surrender charge on top of that, but it would be nice to have a positive credit from the MVA. Now, if interest rates are much higher when you surrender it, then you are going to have a negative adjustment on your MVA charge, which would be in addition to this, let's say 5% adjustment down here. Okay. A lot of people don't understand that. They're not explaining that. Okay. Well, I'm explaining it to you right now. That's how it works. And you can go up here and I'll just show you. If you were to, let's say you bought this and you were taking lifetime income. Okay. And after 5 years, year 6, you're like, I just want to take my money out. Okay. I've taken $37,000 out for the last 5 years. I just want to take my money back. Well, your value is $215,000, right? Is that what you're going to get out? No. you're going to get, let me just look here. You're going to get 202,770. So it's not too bad, but it's still a cost. I mean, you're spending what, 13 grand in surrender charges? If there's an MVA charge, it might be higher than that. So if there's a credit, then maybe your total surrender value would be a little bit higher. Maybe your surrender charges would only end up being like 9 or 10,000. So anyways, that's something to think about. Now, if you're buying an annuity, you buy it for long-term contracts. You're buying it for long-term benefits. Okay, if it's for income, then it's for life. It doesn't really matter because you're never going to surrender it. Okay, if you're buying a MYGA with a fixed rate paying you 5.5% for 10 years, don't surrender it. If you do, you're going to pay surrender charges. And on those, it's not so bad because you've got a guaranteed rate of growth. I'll show you on those. If I were to go in and look at the top MYGAs. All right, so looking at the top MYGAs, you will see that there are decent rates of growth. Okay, let's say you did a 7-year. Let's just look, and this is just showing the top 3. Okay, and Wichita is the top 3 in all these categories. So let me go up here and I'll just say the top, at least A-. Okay, and there's some good B++ companies I'd recommend too, but just for this example, we'll say, all right, Exonic 5.5. Okay, pretty good. So we'll go in here, and these are the total earnings based off of $400,000 going into. If you let it sit for 7 years, it's going to grow to $581,000. Now, if you were to surrender this after 2 years, okay, after 2 years, the account value is going to be pretty decent. I mean, you got 422 and you got 445. I mean, look at these earnings. That's pretty good. But look at the surrender value. It's 409. Okay, at least you're getting your money back, but not very much, right? So it's gonna take a big chunk out because they're charging you 8% right here. So let's say though, you wait longer. Let's say you wait, 5 years, 4 years. Let's say 4 years. Okay, in 4 years, your account value is 522. Your surrender value is 496. So it's not as bad. Let's say you waited all the way to the end. It's not 7 years yet, and your account value is 581. You take out 564. I mean, just wait to the end of the 7th year and you get all your money back. So that's just something to remember when you buy annuities. They got surrender charges if you surrender the contract or if you take more than the allowed amount out. A lot of times they will allow interest only or 10% free withdrawals. Anything above those is subject to that surrender charge. Okay. All right. One other mistake. You really don't want to make this mistake. Let's go back. I just want to show you the income rider once more. And that mistake is not protecting your spouse. It's really important. If you're married and you want lifetime income and you have a spouse that's relying on that income, pick the joint option. Okay? Don't do the single payout. If you do a single payout, then you have to make sure there's life insurance for them or you need to make sure they have other assets, which is fine. I have lots of clients that do that and that works out great. Especially if your spouse is like 15, 20 years younger, sometimes that's the only way to do it because the income is just so low because it's based off of their age. Okay. So that's what you have to, let me just go in here. I just want to show you a different example. All right. So here's a perfect example. You're 66 years old. You want to take income in 5 years and it's a joint payout. Okay. If you take that, it's $4,700 a month. It's never, ever going away. If you die, your spouse will continue to get it for the rest of their lives. And you can see why that's important. See the account value? It goes down. By the time you're 80, it's gone. Okay. The income, it keeps going for the rest of your life. But what if you died at 81 and you're married and they need that income? Not only do they not get that income anymore, but they don't get any death benefit because you see the account value is gone. You see the death benefit over here only lasts as long as the account value. So that's really important. But this is a joint payout, so you didn't make that mistake, and you made sure that it was a joint payout for your spouse, so it never stops. Now, if you did a single payout, then hopefully you're married. I mean, hopefully you're not married. Hopefully you're single. I'll just show you that. So if you are single, it is higher. Yeah. But if you're single, it's fine. So just keep that in mind. And I do have people that are married or that will do single payouts. I do have people that have domestic partners that will do single payouts. You have to be married to do a joint payout. So just keep that in mind. Otherwise, you got to do like a SPIA with a 30-year period certain for a non-spouse. That's the best way to do that. So anyways, it just depends on what you need, but you can't, there's certain mistakes you just can't make. Okay. And those are one of them. All right. So let's see here. See if there's any other ones. Paying high fees. Here's the thing. The only time that you pay fees is if it's giving you something. Okay. These are fee-based. Okay. Look at the fees. They're like 1%. See, 1% rider fee, which is fine. Now, let's say you're like, I don't want any fee. I hate fees. Okay, take the fee away. Now it's like $2,000 less per month. Now, the only value to this is your account value will last longer. Okay, they show you if there is no index growth, your account value will last till you're 84, 85. If there is index growth, then your account value will last till it's 93, 94. Okay, it's simple as that. And your income will be higher if you get index growth, but that's just a big if. Okay, because if it doesn't, you're going to get this income. So you have to realize without some of these income riders, you're going to really take away a lot of those benefits of lifetime income. You still get lifetime income from these things, but it's just not as much. And so you compare that and you say, okay, well, I would love to have higher income. How much of these fees, like, is it worth it? Right? And that's the thing, is you have to make sure you don't make the mistake of paying for fees for something you don't need. If you don't need lifetime income or high lifetime income, then don't choose the fee. Okay? But most of us do. Most of us want that, and we don't care about the balance. We are using our other assets for legacy. So that's totally up to you. But I'll illustrate this. I'll show you the fees. So they're charging you 1%, but they're basing it off of the income benefit, okay, not the account value. So you have to realize that as well. Account value is one thing, but when you look at these 1% charges, you're thinking, well, why are my charges so high? It's because they're based off of an income benefit value that is much higher than the account value and is growing at huge amounts. You're getting huge bonuses. You're getting 8 to 9% per year in growth, and because of that, they're going to be basing that rider charge based off of that value, because that's the value they're going to use to actually generate that lifetime income for you. Okay. All right. So let's go back to the rider, and we're looking at, let me just see if I can pull this up. All right. So with the rider, this is back to a joint, by the way, but if we look at the rider, we're being charged $8,000, $9,000. It looks like, yeah, if there's no growth, it'll last till like 11 years, looks like 11, 12 years. So yeah, I'm paying like $120,000 in rider charges. That's expensive, but I'm getting $20,000 more per year. And you look at that and say, okay, well, $20,000 a year. If I do that for, 10 years, that's another $200,000. If I do 20 years, that's $400,000. If I do 30 years, it's $600,000. You kind of got to decide, is it worth it? Well, if you want highest income, you don't care about the account value, I think it's worth it, because for me, the net income, that's all that's important to me, because this money right here that's coming to me, it is net. Okay, that the fees are not coming from that amount. Okay, I'm not paying those. It's coming from my account value. My account value is influenced by interest rates, the interest that is earning from the index, and it's influenced by the rider charges, and it's influenced by the withdrawals. But in the end, I bought this for a lifetime pension. I literally paid $500,000 in this case for a $1.4 million pension. So this is a great example for why a rider charge makes sense. Okay. Now, buying the wrong annuities, most of the time when people buy the wrong annuity, they're usually buying a variable contract. Okay. That is what I see most of the time. They bought something, they just didn't really understand what it was, and their fees were high, but that's not always the case. But it's just, you have to understand what you're buying. Okay. Another common, I would say, mistake with buying the wrong annuity is they're buying a growth annuity that was recommended by an advisor, and it was supposed to be growth, and they gave them some fancy index they never heard of, and of course the growth did not pan out the way the advisor illustrated, because it's a bogus index. It's an index that was back tested, and they tested it out on their client. That's what they did. And unfortunately, this happens all the time. Like, I have people reach out to me all the time that have this problem, and they're so frustrated. And it's just because their advisor didn't know what they were doing. So I would just kindly ask you, if you're going to take my advice, put your business with me, okay? I've had 2 people this month take all my advice and use it with their advisor that couldn't give them the same advice. So I guess that's my plug for that. Please use me if you're going to take my advice, because I'd love to help you. If you'd like to buy an annuity, book a call. There's a link below this video. There's a link on my website, johnstevenson.com, and check out the annuities first. You can see what they're paying, and then reach out to me if you'd like to buy. I'd love to help you. But again, if you're just going to use that and go somewhere else, please don't. Okay. I would love to help you. I'd love to be your advisor for annuities. This is what I live, breathe, and sleep and talk about all the time. Okay. So this is really, really important that you have someone that is an expert on thousands of products. Okay. That's really, really important. So anyways, if that makes sense, then book a call. Okay. Also, if you like the video, if you like the channel, I hope you're enjoying the videos. I hope you're browsing the channel. Okay, there's lots of videos out there that I am creating that are answering lots of questions. If you like it, make sure you click the like button. Make sure you subscribe, share, comment below, and I'll answer. So I really appreciate you watching. I hope this video is helpful, and I hope that if you do think about making the plunge as far as having an annuity contract as part of your portfolio for your safety, then I highly recommend you reach out to me. I'd love to help you. So again, thank you so much for watching. I appreciate you, and we'll see you next time.